I'm Andy Panko, owner of Tenon Financial, and welcome to Retirement Planning Demystified. This video provides an introduction to Social Security. In addition to retirement benefits, Social Security also pays supplemental income benefits to persons of limited resources and disability benefits to persons who are younger than retirement age but not able to work because of their disability. This video will only focus on Social Security's retirement benefits, not its supplemental income or disability benefits. Social Security can be very complex. This video lays the groundwork for understanding the basics. For more detailed explanations, be sure to check out my other Social Security videos, which each dig a little deeper into particular topics like how benefits are calculated, how they're taxed, how to decide when to start your Social Security, what benefits are spouses and children eligible to receive, what happens if you receive Social Security while still working, and explanations of how and why your Social Security benefits may be reduced if you receive a pension from a public employer. Before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. Everything discussed in this video is based on current Social Security legislation. The laws governing Social Security are subject to change. And in fact, I assume they will change during the next 15 years. As further discussed in my other video, Will Social Security Run Out of Money?, the Social Security trust funds are expected to deplete in 2035. Now that doesn't mean benefit payments will stop completely though, but unless changes are made, it does mean the system will only have enough income to pay approximately 79% of the benefits it's supposed to pay from 2035 forward. Stay tuned for updates. Social Security is likely to be a critical part of the financial foundation upon which your retirement is built. That's because it provides stable and secure monthly income for life. And your benefits will increase over time as inflation happens. In addition to providing benefits to you, Social Security may also provide benefits to your spouse, your minor or disabled children, and potentially other dependents you may have. And upon your passing, it may also provide survivor benefits to your spouse, children, and other dependents. Let's start with some background. Social Security is a federal benefit program that pays a minimum level of lifetime income to eligible retirees. It's important to note I said a minimum level of lifetime income. Social Security is not meant to be wage replacement. It was never intended to provide as much income as what you earned while working. Instead, its purpose is to provide just a minimum backstop or safety net of income. The program is overseen by the Social Security Administration, which is part of the United States Department of Health and Human Services. The system is funded primarily by payroll taxes paid by employees and their employers. The vast majority of people employed in the United States are covered by Social Security, meaning they are required to pay the payroll taxes into the system and are therefore eligible to ultimately receive Social Security retirement benefits. However, not all employees are covered. The following are excluded from coverage: federal employees hired before 1984, unless they opted into coverage, about 1/4 of state and municipal employees, and employees of certain religious organizations. Social Security was created in 1935 when the Social Security Act was signed into law. Payroll taxes were first collected in 1937. In 1940, the first monthly benefits were paid. In 1975, automatic COLA, or cost of living adjustments, began. Prior to that, the government would make one-off increases to benefits as they saw necessary. Otherwise, people's payment amounts stayed unchanged month to month and year to year. Now with COLA in place, benefits automatically get increased each year there is inflation. In 1983, Social Security benefits became taxable. Up until then, benefits were completely excluded from federal income taxation. However, due to financial strain of the Social Security system at the time, the government decided to build in a mechanism to start taxing benefits of the country's highest income earners. Social Security is funded primarily from payroll taxes known as FICA, or Federal Insurance Contributions Act taxes. Covered employees pay a tax equal to 6.2% of their wages up to a cap known as a contribution and benefit base. For 2020, the contribution and benefit base is $137,700, and this figure is adjusted each year in line with changes in the National Average Wage Index. In addition to the employee paying 6.2% of covered wages, the employer pays another 6.2%. That means in total, each covered employee has 12.4% of his or her wages up to the contribution and benefit base paid into the Social Security system each year. So where do those payroll taxes go? They go into the Social Security Trust Fund, which is basically a big bucket. It's actually two different trust funds, but functionally they kind of act like one big shared fund, so I'll refer to it as one. While payroll taxes are the largest source of trust fund income, they aren't the only source. To a much lesser extent, Social Security is also funded by the income taxes paid on Social Security benefits and interest earned on the money sitting inside the trust fund. The funds are used to pay all the program's expenses, which are predominantly benefit payments made to Social Security recipients. But the trust fund also pays for the administrative costs of running the program. Now, to be eligible for Social Security retirement benefits, you need to earn 40 credits during your lifetime. In 2020, one credit is equal to $1,410 of earnings. This amount also changes each year with inflation. You can earn up to 4 credits per year, which in 2020 means you can earn 4 credits with $5,640 of earnings. Once you've earned 40 credits, which you can do in as little as 10 years, you're eligible to ultimately receive what's called your primary insurance amount. Your primary insurance amount is the monthly amount of retirement benefits you'll get if you start your retirement benefits at your full retirement age. Depending on your year of birth, your full retirement age is between ages 66 and 67. If you were born between 1943 and 1954, your full retirement age is 66. If you were born in 1960 or later, your full retirement age is 67. If you were born in the years between 1954 and 1960, your full retirement age is scaled in 2-month increments for each year you were born after 1954. For example, if you were born in 1955, your full retirement age is 66 and 2 months. If you were born in 1956, it's 66 and 4 months. One thing to keep in mind is if you were born on January 1st, Social Security will look at the year prior to the year of your birth for purpose of your full retirement age. In other words, if you were born on January 1st, 1960, your full retirement age would assume 1959 as your year of birth, not 1960. You'll notice I didn't address birth years prior to 1943. Anyone born before then is already well into getting Social Security, so I didn't detail those full retirement ages. But in case you're wondering, full retirement age is less than 66 for people born prior to 1943. If you start your retirement benefits at your full retirement age, the amount you receive will be equal to your primary insurance amount. But you can start your benefits as early as age 62. However, starting before your full retirement age will lead to a benefit which is permanently reduced. And the earlier you start, the larger the reduction. For example, if your full retirement age is 67 and you start your benefits at age 62, the amount you receive will be 30% lower than your primary insurance amount. If you start at age 63, it will be 25% lower. At 64, it'll be 20% lower. At 65, it'll be 13.33% lower. And at 66, it'll be 6.67% lower. On the other hand, if you start your benefits after your full retirement age, your monthly benefit will be permanently increased. Again, assume your full retirement age is 67. If you start your benefits at age 68, the amount you receive will be 8% higher than your primary insurance amount. At 69, it'll be 16% higher. And at 70, it will be 24% higher. These increases are called delayed retirement credits. You can earn delayed retirement credits up until age 70. Once you turn 70, there's no additional benefit to continuing to delay your Social Security. So, how do you know how much your primary insurance amount will be? To learn more about that calculation, you can check out my other video, Calculating Your Social Security Primary Insurance Amount. But in a nutshell, it's based on your highest 35 years of indexed earnings. All your annual earnings up until the year you turn 60 are indexed or adjusted to account for changes in inflation. Then, based on those 35 highest years, a multi-step formula is used to derive your primary insurance amount. But the easiest and most accurate way to find out your primary insurance amount is by creating a My Social Security account on the Social Security website at www.ssa.gov/myaccount. Once logged in, you'll be able to download your full Social Security statement, which shows not only your estimated primary insurance amount, but also the anticipated monthly amount you'd get if you start your benefits at age 62 or at age 70. Your statement also shows the survivor benefits your family members would receive if you were to pass. And it additionally shows your reported annual earnings for every year you've worked. Regardless of your age, I highly recommend you create a login and check out your Social Security statement if you haven't already. There are 3 main benefits to establishing an online account. First, knowing your expected Social Security benefits will help you better plan for retirement. Second, you can review your earnings history to check for errors. If your record is mistakenly missing wages for a year, or if a year is showing lower wages than what you actually earned, your benefit will ultimately be less than it should be. If you can prove there is an error in your record, you can often get the Social Security Administration to correct it, especially if the error is in a recent year. The third benefit to creating a Social Security login as soon as possible is that it prevents a would-be fraudster from maliciously doing it on your behalf. Even if you're only 20 years old and likely decades away from receiving Social Security, establishing your online account now minimizes the chances of someone else doing it for you to try to steal your benefits. Well, that's it for my introduction to Social Security. I hope you enjoyed it. As I said before, Social Security is incredibly complex. This video only scratches the surface, but be sure to check out my other Social Security videos for more detailed information and explanations. And if you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides practical retirement planning tips and info. Also, join my free Facebook group, Taxes in Retirement, where you can get answers to your retirement-related tax questions. Thanks for watching. I'll see you soon.